better to do it when we're drunk, right?
Does that work for you?
Yeah, sounds good. We just pass back and forth.
Yeah. Perfect. So I think the beauty of all this is having Andy's experience to talk about the different types of institutions he was at, what types of recommendations that you would get from places. So whether that was your typical wealth manager that you have today, or a place that he's at now. And then I'm kind of happy to run through investment criteria, things that I look for, and really overall talk about portfolio construction, really the major risks and things that you want to look for as you're evaluating those different hedge funds. And the biggest piece, making sure you don't have kind of hypercorrelation. So I'll turn it over to Andy for a little bit.
Like I said, thank you. Like I said, my name's Andy. I'm a True North Advisors, Raymond James. And before I became a financial advisor, I started off in the Army. So I flew helicopters and did that for a while. After getting back from Iraq, I decided to make a career change. And then I started with Edward Jones and grind that out. I said, if you survive Edward Jones in Iraq, you can survive just about anything. So as I started building my career up at Edward Jones, I started realizing that I had a hard time getting that high net worth client. Yeah, we're going to be informal today. I have PowerPoint slides, but David and I agreed, just make it informal. But I started building my career up, and I had a hard time getting more than $1 million client. And I couldn't figure out why that was. Why was it so hard to get the ultra high net worth? I'm meeting people, I'm making the right contacts, I'm networking. And I'll tell you right now, what it boils down to is alternative investments and hedge funds. Structured investments, all these different things I wasn't allowed to do because I was on the retail side. And, I knew I could do more. And that's why I made the decision to go independent and clear through Raymond James. And like I said, the great thing about Raymond James is they allow you to be the freedom of being an independent advisor, but also give you the resources and tools to present to clients to go after the ultra high net worth clients. And like I said, working with David, I told David, I said, hey, look, David, if what you're building is something that would be something we look at, I'd love to get them plugged in to possibly come on our platform because Raymond James is definitely very open to providing hedge funds. And I tell you right now, like I said, I'm going to kind of get big picture, and David's going to go more into details. The big picture right now is basically where we're at in the stock market. Stock market's at all-time highs. We're over 400%, since the big sell-off, since '08. You got bonds, they're doing terrible with interest rates being at record low. I'm telling you right now, if you don't think...
View on inflation, kind of where we are there?
Yeah, inflation is starting to creep up, and then you have to overcome that obstacle with obviously interest rates rising in the near future. So you got this kind of like this error of just like where it's like, okay, stock market's overvalued. You're just trying to find areas of opportunity. You got the bond market that you can't necessarily just rely on either for alpha. So I think hedge funds is a great way to diversify, to set yourself apart from your peers, especially with, like I said, with companies that can't offer that product. You can definitely stand apart. And Dave, I'm going to kind of go back and forth.
Absolutely. So, I would. It's kind of hard to see, but I would, if I could get a raise of hands, if anyone in the room is invested in alternative investments, hedge funds, venture capital, private equity. All right, so there are a few people in the room. Thank you. And as we kind of think about this, the topic of the discussion was diversifying and how to diversify a portfolio of hedge funds. The problem with that is hedge funds are only one piece of your entire portfolio. And in order to truly have a diversified portfolio, you really need to look at the entire picture. And the reason for that is what we talked about in the beginning, which is risk. And, so I'll throw it out there. What do you think I mean by risk? Does anyone have an answer for that? You can just talk because I really can't see at all. Yeah. I'm sorry. Can anyone tell me what risk is? There's different kinds as well.
Lots of different kinds.
Exactly.
Volatility, interest rate.
Correct.
Yeah.
So volatility is one of the biggest ones we're dealing with right now. But there's systematic risk. There's systemic risk. There's correlation risk. And all of these things are important when you're starting to evaluate hedge funds. And so it's not as easy as saying, don't put all your eggs in one basket, or, I should have a percentage of a long-short equity fund, I should have a percentage of a credit fund, I should have a percentage of a bond fund, have my own side pocket where I trade my own equity. Really what you have to do is dig deeper. And the problem with that is it takes time and it takes resources. And so having those resources that you can count on, like Andy, and some others that are in the room today that have received awards, those are people that I encourage you to work with, because it's very difficult to do this on your own. And, I work with people that have teams of 40, 50, 100 people, and they're family offices. And these family offices run like hedge funds, but the reason why is because it takes that many people to actually evaluate the material. But one of the biggest things for me and kind of a turning point in my career was realizing that in order to kind of grow my personal wealth and to do that for families that I was working for, I had to create a systematic, repeatable process. And that systematic, repeatable process is one that I've been able to put to paper, and it allows me to evaluate similar funds on similar metrics. And probably the most common is a Sharpe ratio. And I'll go back out to the room. Anyone know what a Sharpe ratio is? What's the Sharpe ratio? No, I'll answer the question. Exactly. So do you want that to be positive or negative? Positive. Correct. And hopefully over what number? 1, right? So if you have a Sharpe ratio of 0.5, it would mean that you are taking more risk in order to get a lower return. And so really putting things to paper and making sure that you are evaluating every fund on the same set of metrics, because it's kind of funny, when you start looking at all these tear sheets, everyone has the ability to make what they're doing look okay. And you have to be able to be the one to say and ask the right questions, so you have the ability to follow these funds through their life and watch what they do. And there's hedge funds that have been around for 20 plus years. And frankly, they tend to get the lion's share of the capital, but that doesn't mean there aren't incredible emerging managers. And, I don't know what Andy sees.
I just see, like, when it comes to hedge funds, one of the biggest things I think is very attractive for me, for my clients, is just the disclosures. You don't have the same disclosures requirements as retail. So, like, if a manager decides to sell Amazon, they're not having to do full disclosure to make it go public, and then all of a sudden the fund starts falling down, right? So there's a lot of advantages to that. And also just the long and short idea, that's probably 43% of the market of hedge funds is long and short. That makes sense to me, even though the first quarter of this year it didn't do so well in most sectors of the long and short, because everything seemed like it went up. But overall, when you have volatility, to think about buying a company that is going to bankrupt or go down, addition to long positions that you think are going to go up, that's a cool strategy. I like that. That's very appealing to me.
Yep. Okay. I would say the only problem, and we've seen it recently, I'm sure a lot of you followed the GameStop case with Reddit, and so you could have 3 or 4 different hedge fund strategies and actually be exposed to the exact same stock, whether it's through leverage, synthetic, through options, or an event-driven fund that's playing for a specific scenario happening. And that's where I would tell you that you really have to be involved, or your wealth manager has to be involved, in creating this portfolio construction because the hypercorrelation risk is very high.
Yeah, and that's it. That's the problem with retail investing is like if you'll notice all the top mutual funds that all your clients have or yourself, they all have what's the top 10 holdings? All tech, right? Amazon and
it's all of the Facebook,
Amazon. Just a typical. And it's like, okay, well, we all know that obviously I'm not necessarily bearish about tech, but just the opportunity of using hedge funds to help diversify against that is crucial.
It's active management.
Yeah.
And I think one of the biggest things that hedge funds get knocked for is fees. Typical hedge fund fee is 2 and 20. Some are 3 and 30. But they need to be able to justify that through their performance. And I would say ETFs, over a period of time, the market's gone straight up. A lot of these younger portfolio managers have never seen a cycle, don't know what a cycle looks like. And last year, as everyone knows, was a very volatile year. It was actually one of the best years we've had for stock picking in a very long time. And those portfolio managers that are really good at picking stocks outperformed massively. So the things that I like single managers. I like single managers that have a very specific expertise, that follow a sector. I think the multi-manager platforms that run market neutral is not where you're going to find the most alpha. It works really well for the fund. It doesn't work really well for the investors. So I would say look for people that are experts in the space that they cover and who hire people like that also. It also helps you to diversify your overall portfolio when you know exactly what sector and space that those people are working on. The other big things, we talked briefly about emerging managers versus established. I would say if you can find an emerging manager that has worked at an established fund that's breaking out on their own, where the head of the previous firm is giving them capital to help launch the fund, and you have the ability to get in, usually that type of fund within the first 3 years overperforms. And they overperform because they have something to prove. And, as we looked at some of the top performers from last year, there were ones that were in the 70%. So it's active management, I think, is back. I think volatility is here to stay. And I think people who thought that they could create similar types of performance through ETFs or commodity exposure, indexes, I think are going to have a more challenging time.
Yeah, especially considering the valuations of the markets right now. I mean, this is more importantly than anything is just picking the right stocks in the right sectors. So I think that I think definitely just pick it.
Manager platforms make sense.
Yep, exactly. And like I said, my job as being a financial planner at CFPs is, like I said, I really putting the pieces together. So really figuring out what your goals are and your risk, and also what the big picture looks like and how you can fit those pieces of puzzles together. My experience is, I'm using alternative investments in hedge funds. It's usually people between $5 to $10 million plus, maybe $1 million or 500,000. We still can do it, but most of my hedge funds, they usually have minimums of 500,000 to get in. 250 is the lowest I see. Do you guys have a minimum with your product?
We do. 500's a minimum with us. The other piece that I wanted to spend a little time on and point out is, and it's kind of a funny story from here in Vegas. I happen to be here with a multi-billionaire that was the head of a fund, and he's trading billions of dollars of stock a day. Watching him peel $100 out of his pocket to play roulette or craps was literally like you were taking his last dollar. And I asked him, I said, why is it so hard for you? And he goes, because I have no advantage. because I can't do any work. And so he's good at what he does because he spends the time, energy, and effort to do it. And this to him, whether he wins or loses, he feels he's going to lose. And he feels he's going to lose because he doesn't know why. And that's the biggest problem. But having active management, I think is, it's definitely here to stay. The other thing that I'm seeing happening at a lot of funds, and so in addition to checking out their overall decks, their one-pagers, something that has started to happen in the last 2 years that I haven't seen since 7 and 8, and that's exposure to privates within mandates. And privates are liquid or illiquid? Illiquid. So the problem with that is if you have a hedge fund that's part of your overall portfolio that has the potential for 35% exposure to privates, and you own a bunch of direct deals yourself, then you all of a sudden you have a lot of illiquid assets within your portfolio, and you need to make sure if something does happen that you don't have to sell your winners in order to get liquidity.
Yeah, and that's usually why I try to set some guidelines, and our firm sets guidelines too, 5%, 10% net worth. There's a reason behind that with some of these products because, like I said, the advantage of that is you don't have to worry about sell-offs based on news, media, just media driving your portfolio returns. That's probably why I'm so appealed to that market, but also, having the liquidity is important too. So there's a balance between that. If I had to look at a portfolio of $5 million to $10 million, a couple of your strategies might be in that pot. I might have Alkeon Growth out in New York. They have a great long and short strategy. I'm sure you've heard of them.
Focused on TMT.
TMT, yep. And then Hudson Bay if you want more preservation. Yep. It's not gonna hit home runs, but back in 2008.
They do some event driven too.
Yep, they do. And in 2008, when the market crashed, it did 18% that year. So it's good to have a little bit of hedge diversified portfolio.
Absolutely.
Yeah.
And yep. So it's a really good question, and I would say it sounds like from the way that you're asking the question, you don't want to jump into anything. You want to create that criteria like we talked about. There are resources out there like Cambridge Associates that does a lot of work, and they try to create a uniform platform for people to be able to evaluate funds on an apples-to-apples basis. And there's other sources other than just Cambridge, but Cambridge is probably one of the best, and it's been around for a long time. Yeah. So you want to make sure you keep tabs on the funds that you met with. So ask them to put you on their distribution. You'll get the quarterly updates. You'll be able to see if, in fact, they live up to their mandate, which I think is extremely important also. And I never make an investment in a fund unless I go see them and unless I talk to the top people within the firm. You'll pick up a lot on body language, culture, and just overall how it feels. And, your gut has something to do with this too. I'm a big fan of, like I told you, systematic, repeatable process and data, but you have to trust your gut too. And you want to do business with people that you like. And I think those things should not be taken for granted, and try to spend as much time with people as possible. I had a rule that I had to have a beer with anyone who I put money with. And the reason for that was people act differently outside of the office than they do in. And it allowed me to see how people treated others and just how their mannerisms, how they acted. It all directly correlates to performance over time and how they treat their employees, how they hire their employees. And those are all big things.
That's great. A great question. Did you get the answer? Yeah.
Yeah, I have a mic.
Yes.
That's the same company that does the SMA due diligence, right?
Yeah.
So do they do the same thing with hedge funds, where they've done some of the due diligence and take a lot of that work off our shoulders?
They will basically give you a 2 to 3 pager on any fund
Nice.
you're looking at, and break down everything from the alpha, the beta, the Sharpe ratio,
Okay.
assets under management, exposures to portfolios, that pie chart.
Yep.
Healthcare, TMT,
Okay, sweet.
what they're good at, where they came from. Pedigree is important too. So people get trained by people that are really good. So the Julian Robertsons of the world, the Tiger Cubs, they all happen to be in 101 Park. But for me, someone who was trained by Larry Robbins at Glenview, I know they're going to be really good at consumer and they're going to be really good at healthcare. And, someone who trained with Julian, they're going to be great at privates and they're going to be great at tech. So you can kind of look at that history and someone's resume, and if they've covered industrials and TMT, but they're launching a consumer retail fund, I'd be concerned.
Yeah, like I said, obviously, where you clear through, even on the RIA, I'm sure there's resources that you have that you're clearing through. Obviously, Raymond James is who I use, pretty much 100%.
Bloomberg,
Yeah.
Zacks, are just a couple others that, we'll put things together. But I think for me, the most detailed is definitely Cambridge.
Yeah. Anyone else having questions in the crowd?
And talking to other investors.
Yeah. Like I said.
Asking for a reference.
Yeah.
People will say.
I'm sorry,
"You'll
if
never
you
get a
can,
bad reference."
if you can use the mic for the live feeds.
No
that's-
problem. People will say you'll never get a bad reference. Well, you should ask for one. You should ask for 2. You should ask for 3. Sometimes they'll even ask for someone who's redeemed. And they should be willing to give you that. So don't be scared to ask the questions that you want to ask, or ask your wealth manager. That's why you have them. So open it up for any additional questions. But the other interesting thing that I think is happening while I'm waiting for all the hands to go up is the other alternatives that are starting to become interesting. Direct investments within artwork, within wine. Blue chip wine has outperformed the S&P 500 by more than 13% over the last 20 years. So all of these assets, post the 2017 Jobs Act, have the ability through crowdfunding or securitization to be able to be broken up into pieces and owned by a bunch of different people. And I think I'd be remiss if I didn't mention the fact that everyone now has the ability to invest in those types of products. And in fact, some of the most interesting things I'm seeing are in the credit space. So being able to invest in a completely securitized asset and receive double-digit returns for a short period of time, 90 days, 120 days, annualized 12% return, pretty good and pretty safe, especially with a 65% LTV.
Yeah, definitely adding hedge funds and alternative investments can definitely increase alpha, for sure.
There's no question.
No question.
I think there was a question in the middle.
So would blue chip wine be considered a liquid asset?
It is an illiquid asset.
That was a joke, I'm sorry.
Anything that doesn't trade on an exchange is considered illiquid.
Okay. No,
But stay tuned, because there's a number of secondary exchanges that are in the works, and I think there'll definitely be liquidity within the secondary marketplace for everything from some of the alternatives we're talking about and even hedge fund positions. But I don't know if anyone here follows the collectible market, but whether it's commodities, gold, silver, baseball cards, all this stuff's on fire right now. And part of it, I think, is probably COVID related. People at home going through boxes and their stuff, artwork, all this, you would think that spending wouldn't be happening in those types of assets, but they are.
So the comment was because wine is a liquid, he was wondering whether or not it was a liquid.
So I heard the illiquid piece. I didn't hear the last
Yeah,
part of that.
sorry, yeah. So anyway, I thought it was a great joke.
What was that?
It was a great joke. Yeah. So anybody else have a question?
I guess I'll just kind of wrap up. I'd say, who all here is financial planners, financial advisors? I'm just curious in the room. I got Miss Divorce Specialty over there. Anyone else? Okay. Yeah, so like I said, I think kind of end on this is I think a majority of the financial advisors out there really just do retail. Would you say? I would say
Not necessarily.
majority,
There
but
are-
a lot.
They're wealth managers
Yeah.
for everyone.
Yeah.
And, even for people who are not ready to have their own family office, the bridge to that is a multifamily office.
Yeah.
So I would say, depending upon the camp that you're in, depending on the type of assistance that you need, I'm happy to talk to anyone on a one-on-one basis. I know Andy is too. Make recommendations on who you should be speaking with. But the reality is, you should be on a regular basis be evaluating your manager and your portfolio. And so I would pick however many times a year you want to be able to do that. You should be rebalancing, and you shouldn't just let it run. So make sure that you have a date set at least once a year that you're going to sit down and do that. And I think you'll find you continue to refine your process over time. And it's that refined process, it's the data, and that helps with the decision making.
Yeah, I just, like I said, for diversification, just be open to other ideas, whether it's opportunity zones or whether it's, long and shorts or hedge funds. I really embraced it when I left Edward Jones. I couldn't figure out how I was able to get that, the $1 million plus client. I was able to by simply having more product lineup. And like I said, just look outside the box is what I'm saying pretty much to conclude this meeting.
There's a lot of ways to generate alpha outside of the stock market, and it should be a piece of everyone's portfolio. And the biggest piece that I've seen grow in the last few years is exposure to alternatives and direct assets. So,
We have a question over here.
yep.
Got a very quick question. So I know you mentioned gold. So what do you think is the sound?
I'm having a hard time hearing you.
Maybe a little hold.
I can come to you.
Okay, can you hear me now?
A little bit better, yep.
Okay, so you talked about gold a little while ago. So what do you think about positioning gold and REITs into the overall portfolio of the client as a hedging strategy for inflation? And if so, what percentage of the portfolio would you recommend for that?
So there's multiple ways to invest in gold. So that's, I think, the first piece you have to consider. Do you want to own physical? Do you want to custody physical? Or do you want to own an ETF? And all are possible. Obviously, owning an ETF is the most liquid. But I believe that, for me, all commodities right now, gold, silver, platinum, palladium, are going to be on a massive run. And the reason why I believe that is because all of those precious metals that I just mentioned have massive exposure to the EV market, lithium batteries, and so the inputs for chips and overall technology products that are going into the things that are being manufactured today that we're going to be using in the future, all of those are going to go up.
Yeah, I'd say there's not a one size fit all. I mean, based on people's risk tolerance and everything. But I mean, it's pretty customary for me to say that clients might have 10% in commodities in a portfolio. You might, if you're more bullish in that area, nothing wrong being a little heavier, but that's how my practice is. It's a balance being a financial planner, not to be, be diversified, but don't be dumbification. I call it dumbifications where just you got 2% here, 2% there. If you think small cap and small cap value is going to do better than large cap this year, then get heavy in different areas. I agree with you. Getting heavy in commodities might not be a bad position to take.
Yeah, I think it's worth taking a look at further. And, I've got a bunch of research that I could share with you to support kind of my thesis on the inputs for all of those and what it looks like over the next 5 to 7 years. Did that answer your question? Great.
Any other questions from here? Well, one of the observations that I made from this particular conference is that there has been a great deal of networking going on here. So we have about 15 minutes before the actual lunch period. And I think it might actually be a good opportunity for people to be able to come up and speak with you,
Yeah, I'm happy
gentlemen,
to.
or for you all to network with
Andy and I can both take a
other.
table.
Yeah.
And if
sure.
people want to come talk,
Yeah.
happy to do that on an individual
Terrific.
basis because
Great.
it is hard in a group setting, which is a reason why I typically would never go to a group luncheon or dinner to find out about a fund.
Yeah.
It's a very personal thing, and you want to be able to have that direct interaction with someone. So I think that's a great suggestion. We're happy to do it.
Yeah, and with that, we'll have Brian come back up, and thank you, gentlemen, for a wonderful
Yeah, no,
presentation.
thank you guys.